A question we often get is, do you have to pay income tax on as a beneficiary on an inheritance? And typically the answer is going to be yes and no. Depends on what you're inheriting. So for example, if you inherited a brokerage account full of stocks and bonds, you're not going to have to pay income tax on that. You could pay capital gains tax, but here's the advantage. When your loved one passes away, they leave their assets in a brokerage account to you, you get a step up in basis. So if they paid $40 for Apple stock and now it's worth $500, you get the $500 as a cost basis now. The step up went from 40 to 500. And then if it grew by another $10 before you sold it, then you'd pay capital gains tax on that $10. Or if it lost $10, you would get a capital gains tax credit. If you inherited an IRA, that's a little different. You would pay income tax on an IRA because that money was never taxed. So the government wants what's theirs. You'll have 10 years to pull that money out and pay income tax on it. Probably the worst inheritance to get is an annuity. No one ever wants to inherit an annuity because even if there is a cost basis associated with it, any gain you have is going to be taxed as income. So if you have an annuity, you might want to consider finding an alternative to that if you can get out without all the penalties, because that's not something you want to pass to the next generation. Kind of maybe if you don't like them. We're not big annuity fans here at Wiser Wealth. A Roth IRA would be another choice. That's inherited tax-free. You still have to pull it out over 10 years, but the money is tax-free income. Real estate is often inherited. Real estate gets a step up in basis as well. So if you bought the farm for $500,000 and now it's worth $5 million, if you sold it alive, you'd have to pay capital gains tax on the difference. But if you pass it on to the next generation, their cost basis is now $5 million. They go and sell it for $5 million. They paid no tax. So passing real estate to the next generation is a great way to pass through wealth. Now, when your assets get over around 24 million plus or minus, then you start running into the estate tax, or some people call it the death tax. So if you have assets above 24 million, the estate would have to pay tax. This is where, if you look at farming, big farming, you could have farmers that live on modest incomes but own just tons of land for corn or soybeans or whatever. And when that passes to the next generation, if that land is valued above that $24 million mark, you could be in a situation having to sell the farm in order to pay the government tax bill. That's partially why over the years I think that the exclusion has been moved up to be so high as to protect business owners from that tax. Now in 2026, all this resets itself in January, and then all that comes tumbling back down probably to around 10 million, but we don't really know quite yet. So it gets more complicated, obviously, depending on what you're inheriting. But for the most part, anything outside of an IRA is going to get a step up in basis. You want to hopefully avoid annuities and passing those to the next generation. If you do receive an annuity, then there'll be some different liquidation options. You just don't want to reinvest in one for sure. And then if you have the opportunity to inherit things, obviously a Roth is always the better way to go if possible, because we know that one's completely tax-free. Anyway, I hope all this clears some questions up for you. You're always happy to, we always welcome you to reach out to us, and we can answer your questions. Thanks. Bye-bye.